Welcome to Option 4 All. Today's lesson is position sizing. Part 1, how to set the right trade size. Imagine this. You've been growing your account steadily, but one oversized position suddenly wipes out months of progress. If you've ever faced this, you know why mastering position sizing is essential for protecting your capital and ensuring consistent growth. Here's the truth. Professionals don't trade randomly. They calculate, they adapt, they measure every decision against their account size and market conditions. Today, we're breaking down exactly how to do this. Let's start with the foundation. How much should you risk on each trade? Use your actual account equity, not margin or borrowed funds. This is critical. If you have $25,000 in your account, your risk allocation per trade is typically 1 to 2%. That means $250 to $500 maximum risk per position. This consistent approach keeps losses manageable and lets you recover quickly from drawdowns. Why these percentages? Because they're proven. A $500 loss on a $25,000 account stings, but it's recoverable. Multiple $500 losses don't blow you up. This is the discipline that separates professionals from traders who blow accounts. Now calculate your own number. Take your account balance and multiply by 0.01 for 1% or 0.02 for 2%. Write it down. This is your baseline risk per trade. But here's where most traders miss the mark. Markets aren't static. Volatility shifts constantly, and your position sizing must shift with it. When volatility is low, say the VIX is below 15, spreads are tight, and the market feels calm. You can comfortably work toward the upper end of your allocation, maybe 2% per trade conditions are stable. Risk is contained. Now imagine a shift. Earnings season hits. Inflation data surprises. The VIX jumps above 25. Volatility has doubled. In these conditions, tighten your allocations immediately. Drop from 2% down to 1% or even below 1%. This isn't fear, it's adaptation. When volatility rises, potential moves expand, and your fixed dollar risk can translate into larger account drawdowns if you're not careful. This is dynamic position sizing in action. You're not ignoring the market, you're responding to it professionally. Let's walk through a practical example. Say you're trading QQQ, the NASDAQ ETF. Market conditions are normal, and you have a $30,000 account. Your 2% allocation is $600 per trade. You want to sell a call credit spread, maybe the 410/415 spread, collecting $2.50 in credit. You calculate the max risk is around $250 per contract. With a $600 budget, you could trade 2 contracts, locking in roughly $500 in risk. That fits your plan perfectly. Now, fast forward 2 weeks, the Fed signals rate hikes and volatility spikes. Your same trade setup exists, but now conditions are different. You adjust. Drop to 1% allocation, $300 per trade, trade just 1 contract instead of 2. Your risk is now $250, safely under your new threshold. You're lighter on exposure, but you're still participating. You're still winning trades. You're just protecting yourself during uncertain times. This adaptability is what keeps pros in the game. Let's check your understanding. You have a $20,000 account. The VIX is at 12, indicating calm markets. What's your recommended risk per trade in these conditions? A. 5% of your account, or $1,000. Either B. 1 to 2% of your account, or $200 to $400. C. 10% of your account, or $2,000. As much as you want, since volatility is low. Take a moment to choose. Here's the correct answer. B. 1 to 2% of your account, or $200 to $400. Even in calm markets, staying disciplined with 1 to 2% allocation protects you. If volatility spikes unexpectedly, you're already positioned defensively. Professionals don't jump allocations just because things feel safe. To summarize, here's what you need to remember. Calculate your risk allocation as 1 to 2% of your account equity. Use this number as your baseline per trade every time. Monitor volatility and adjust downward when the VIX rises above 20 to 25. In calm markets, stay at your normal allocation. In volatile markets, tighten up. Write down your numbers and stick to them. This discipline is what separates winners from blown accounts. Thanks for joining today's lesson. If you're ready to elevate your trading expertise, join our Option 4 All Community and School, where professionals connect, learn, and share advanced strategies. Enjoy live sessions and exclusive Q&A discussions to support your growth. Find the link in the bio and video caption. For even more insights and updates, follow Option 4, all on Instagram, YouTube, X, and Facebook. Your journey to expert trading continues here.